Food and Agri Research Team, FAR, has just issued their 2015 Outlook. The outlook for 2015 in agricultural commodities is quite positive. However, there are a number of swing factors to keep an eye on for the year. One of the big swing factors, of course, is the weather. So we've had a close of 2014 and start of 2015 with increased rains across a lot of Australia. However, that's off the back of what was quite a dry year for the eastern states, and there are significant soil deficits in place for some of the regions still taking place. So this year, in the first half of the year, we will be hoping for increased or wetter than normal conditions to actually bring back good soil condition. However, the outlook for the first part of this year is possibly for a drier conditions than would be normal. If we do receive the rains we need, especially in northern New South Wales and southern Queensland, then it should result in good conditions going through into 2015. But we're really looking for those rains to take us through that. If the El Nino develops, then it will mean conditions are tough and continuing to be tough for both grazing and some cropping areas across Australia. And this will impact production for those areas. Another one of the major swing factors is, of course, currency. For Australia, being a major exporter of our agricultural commodities, currency is very important, and the Australian dollar versus the US dollar is one of the most important currency rates. The Australian dollar has weakened against the US dollar considerably in the latter part of 2014, from up around the 90-cent levels to the low 80s. And this is a good thing for Australian agriculture. The reason for this depreciation is that the US economy is seen as starting to come out of its recessionary levels. Also, the Australian economy does not look as strong as it looked earlier in the year. The reason it doesn't look as strong is, of course, mining and the demand for mining commodities out of China. The US economy is already starting to pick up employment, has stopped its quantitative easing, and there is some talk about interest rates starting to increase at some time in the US economy. Of course, with the US dollar stronger against the Australian dollar, that's good news for Australian farmers. However, if the US dollar strengthens, commodity prices will come down to some extent in relation to that stronger US dollar. The important part is that the Australian dollar has actually weakened against some other commodities, other currencies as well. And this would mean that we will get a sustained lift in our revenue versus the US dollar commodity price. And that's a good thing for Australian farmers. On the downside, of course, import of machinery and other input costs into Australia will be affected by that stronger stronger US dollar, and will affect the cost for Australian farmers. So in summary on currencies, although the Australian dollar is still strong against many currencies, it has depreciated to some extent against some of our major trading partners, and that is a good thing for Australian agriculture. Of course, with a weaker Australian dollar, one would expect the oil price to be higher, and as oil is a significant input cost for Australian farmers, this would be a concern. However, global supplies of oil have been quite high, and the oil price has, as everybody has seen, come off significantly, and this is a good thing for Australian agriculture generally. On the downside there, cheap oil means that there are cheap synthetics that can be produced, and that could be more competitive for some of our wool and cotton industry sectors. And also, cheap fuel will affect some of our competitors. One of the major swing factors, and continues to be, for Australian agriculture and Australia, is the Chinese economy. When we look at the Chinese economy, the forecasts are that the growth rate is coming back from somewhere around 8.5% down to about 6.8%, and this is talked about quite a lot as a concern. The 5-year average was 8.5% for growth in the Chinese economy. But if you look at that, an 8.5% growth in the Chinese economy for 5 years would mean that today the Chinese economy is 1.5 times the size it was 5 years ago. So a 6.8% growth rate in the Chinese economy today is equivalent to something like a 10% growth rate in that economy 5 years ago. So the Chinese economy is still going to be a strong driver for Australia and Australian agriculture. And we are seeing an increasing demand coming out of the Chinese market. So there is good hope for the Chinese market continuing to take Australian agriculture and having increasing demand for it, and continuing to be a major player for Australian agriculture. The Chinese government manages the economy very, very carefully. And although we can't clearly see what they're doing in there and get very, very clear signals on it, there is some confidence that's been built up over a long time on the Chinese government's ability to manage that economy. Still at quite strong GDP growth levels compared to the rest of the world. So for us, if we're pegged to the Chinese economy, I think we can look at that as a positive aspect for agriculture in Australia. Of course, if the Chinese economy does have a significant shock, this will affect the world. It won't just be Australia, and that will affect Australia from the global perspective. So a significant shock on the Chinese economy, which isn't expected, could happen, and if it does happen, that would be significant for the global position. So a free trade agreement with China would seem like a good thing to do, and we have one in place now, and that's a fantastic thing for Australia. 2 other FTAs in place along with that to our other major trading partners are very good for Australia. And this looks well for agriculture. It reduces some of the tariffs, gives us a more level playing field for our competitors to go into, and allows us to leverage more off that demand that's coming out of China as they favour the quality of Australian produce. However, we need to keep an eye on what's happening with other countries. So, for example, the issues with Russia, where they've banned Australian imports, is something that can happen anywhere around the world. In tough economies and tough times, countries can actually do things to protect their own economies and their own people that may affect us. And these are the things we need to keep a bit of an eye out for. Although I think our major trading partners, being the US and Asia, are still in strong condition to continue to trade from us in a good manner. So the outlook for commodity prices and commodities, agricultural commodities for Australia, is quite positive for most commodities. And if it's not positive, it's flat. If you look at dairy for a start, lowering supply around the world, we believe will start to underpin price and a bit of a recovery in price going into 2015, which is good from the current levels that are happening globally. Wheat, very strong stock levels around the world has meant that wheat prices have been very low. Although we did see a tick up at the end of the season in Australia, which many farmers took advantage of. We think that wheat prices will start to rise as we go through 2015 to some extent. And beef herds have been reducing around the world, specifically in Australia, and the negative thing there is, of course, most of the reduction in herd has been off the back of the very dry conditions, destocking rates. In the US, there's also been a long and gradual reduction of the herd taking place, and yet there is an increasing demand for beef out of China and other parts of the world, and the US has got an increasing demand for beef as well. So as the weather conditions turn around and people stop destocking and start rebuilding herds, we see there are strong beef prices going through 2015 and beyond. Sheep prices, we believe, will be steady going forward and continue to be good prices for sheep, for farmers producing sheep.